introduction of the new IFRS 15 standard has created a drastic shift in the revenue recognition rules. IFRS 15 Revenue from Contracts with Customers introduces new rules and guidelines that will be summarized in this video. We are from Kong Lim and Partners, Chartered Accountants of Singapore, and we are here to help you understand IFRS 15 and how to apply it. The biggest issue is recognition. When and how to recognize revenue under the new IFRS 15 standard. In the past, there were various guidelines showing us how to recognize revenue in various circumstances. However, with the new change, applicable from 1st January 2018, all the past guidelines become redundant and IFRS 15 takes over them, having one standardized guideline for everyone to follow in any situation. Do note that this is very similar to the American Standard FAS Topic 606. While you should apply IFRS 15 to all contracts with customers, there are some exceptions. You do not apply it to lease contracts, insurance contracts, financial instruments, and other contractual rights or obligations that belong to IAS 39, IFRS 9, IFRS 10 and 11, IAS 27 and 28, and non-monetary exchanges between entities within the same business to facilitate sales. Once that is understood, it brings us to the 5-step process of revenue recognition. Going through this 5-step model will help you answer the question of when and how to recognize revenue under the IFRS 15 standard. Let us go through what these steps are. Step 1 is to identify the contract with the customer. Step 2 is to identify the performance obligations, or PO for short, in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligation in a contract. And step 5 is to recognize the revenue when or as an entity satisfies a performance obligation. Each step has its own complications, which IFRS 15 guides us to tackle. In this video, you will be introduced briefly to what each step has to offer. Let us begin with step number 1. First, we have to understand what is a contract. A contract is an agreement between two or more parties to perform a service, provide a product, or commit to an act that is enforceable by law. A contract can either be written or verbal. All contracts must meet 5 attributes at the start of the arrangement. Attribute number 1 is that parties to the contract must have approved to the contract and are committed to perform the obligations. Number 2, each party's rights to goods or services can be identified. Number 3, the payment terms for goods or services can be identified. Number 4, the contract has a commercial substance. And number 5, it is probable that an entity will collect the consideration, which is the customer's ability and intention to pay. Do not be confused, as we have just learned 5 steps to 2 different processes. Let us recap. The first was learning the 5-step process of the IFRS recognition model. The second is within step 1 of the model, teaching us the 5 attributes to meeting a contract. Now, going back to the IFRS 15 5-step model to revenue recognition, we come to step 2, identifying the performance obligations in the contract. First, let's define what is performance obligations. A PO is a promise in a contract with a customer to carry out what the contract says. For example, hiring a photographer for an event, which is a distinct service, or hiring an accountant for monthly accountant services, which is a series of distinct services of the same pattern. A contract to these services can be treated as one performance obligation even if it spans a long time. The key thing in this second step is to be able to identify if the performance obligation is to be treated separately or distinctly. Let's move on to step 3, determining the transaction price. As with all our other steps, we define the main point in each step. Similarly, let's break down and identify what is a transaction price. It is the amount of consideration to which the entity expects to be entitled in exchange for transferring promised goods or services to a customer. There are additional considerations involved in determining transaction price, which will be covered in episode 4 of our IFRS 15 Made Easy series. Next is step number 4. Allocate the transaction price. The main objective is to allocate the transaction price to each performance obligation that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring the goods or services to the customer. So, how do we meet this objective? We need to base this transaction price to a relative stand-alone selling price. The definition of this is the price at which the entity would sell the promised goods or service on a stand-alone basis. Therefore, we must determine the stand-alone price before allocating any transaction price. However, there are exceptions to this rule: allocating discounts and allocation of variable consideration, which will be discussed in another episode of our series. The last step of the 5-step revenue recognition model is to recognize when or as an entity satisfies a performance obligation. First, we have to look at when a performance obligation is satisfied. This happens when a promised goods or service is transferred to the customer. In other words, when the control over the goods or service is transferred. Now the customer has the right to use the goods or service. Secondly, we have to look at how can a performance obligation be satisfied. It can be satisfied over time or at a point of time. Details of this can be found in our other videos of the series. We have now come to the end of our very brief introduction of IFRS 15. Please view our other videos in this series if you would like to learn more about the standard with in-depth examples to help you understand it better.